Portfolio optimization is likely something you've heard of, or you may have heard the term optimize and wondered what it really meant. So that's what we're going to get into next. At this point in the process, assume you've selected your stocks, you've put them into your portfolio, and now you're ready to optimize your portfolio. So what does that term even mean, and what sort of math is going on behind the scenes? A lot of trading firms today have optimizers integrated into their trading platforms where you can just go and click a button that says optimize, and then it'll tell you how to set up your portfolio. And if you don't use a major firm's trading platform that has something like that, there are a bunch of apps and stuff out there that can help you do that. What I want you to walk away with, though, is what the term optimization actually means. And in this example on your left, you'll see a stock portfolio as well as a risk-free portfolio. So that is not only an optimized portfolio, but that is a portfolio that's been optimized and had risk aversion applied. Risk aversion, in case you forgot, is just when you're breaking your investments into risky and risk-free portfolios. And portfolio optimization, however, is about finding the optimal portfolio and splitting up your risky portfolio in a way that aligns with the best historical result. So how exactly does it do that? Well, what the computer does is it creates thousands of different portfolios with random weight sets and tests them using historical data to determine which one produced the best return while taking on the lowest amount of risk. So essentially, the computer is looking for the portfolio with the optimal slope on the capital allocation line. But before I start to confuse you with all these terms, why don't we walk through an example? Now, here are a whole bunch of portfolios that our system generated for this test. In our tools, what we do is generate 5,000 unique portfolios every time the optimization button is clicked. The 5,000 portfolios are sets of random weights for the quantity of assets that you have in your portfolio. And the weights are then applied to the assets that you have and tested to find out their expected returns and their risk levels. In this graph, you have your expected return on your vertical or your y-axis, and then your risk is on your horizontal or your x-axis. If we were to graph all of the different portfolios, this is what a sample of them would look like. The dots that are colored blue are then referred to as the efficient set, which are the portfolios where the capital allocation line slope is positive. So these are the efficient portfolios that you would want to consider. And before we get more in depth, I just want to point out this portfolio number 1 down here in the orange circle. You can see just below that is the calculation behind that portfolio. And in this example, the expected return was a 0.24 and the risk was a 3.8. So that actually produces a negative slope for the capital allocation line, which is why it's orange and not part of the efficient set. At this point, I've mentioned the capital allocation line a few times. So what is that? Essentially, it's a linear projection of how much return the portfolio is producing for each unit of risk. And you're drawing a line from the risk-free rate where it intersects the y-axis to the portfolio. And remember that, like we said earlier, your minimum acceptable return is the risk-free rate. So no matter what, you shouldn't settle for anything less than that return. Those orange dots all produced returns that were below the risk-free rate, which is why they are not part of the efficient set, and we don't consider them for our final weights. There are other options with the blue that have positive slopes, but what we want to find is the portfolio with the highest slope, and as a reminder, the slope for the capital allocation line is the risk premium divided by the variance, then multiplied by the standard deviation. So what the math is trying to determine is which portfolio is giving you the most return for each unit of risk. The portfolio that does that is called the optimal portfolio. And once you've identified that portfolio, then what you do is you go back to the system and refer to the asset weights in that portfolio, which are shown here in the upper left. For the 5 stocks in this portfolio, these were the asset weights from the optimal portfolio. Then what you do is you take the amount of money that you're looking to invest and you multiply it by that weight. That will give you the total amount of money to invest, and from there you divide that by the share price, and that tells you how many shares to buy for each stock. Now that you understand the basics of portfolio optimization, we need to discuss how frequently you should be optimizing your portfolio. What we mean by that is how often you should actually go out to the market and buy stocks or rebalance to your current optimal portfolio. And in order to help you determine that, there are a lot of recommendations made by financial professionals, but we wanted to see what actually worked, so we built some additional tests to see if we could find out. The timing of optimizations that we tested were weekly, bi-weekly, monthly, bi-monthly or every 2 months, quarterly, which is every 3 months, semi-annually or every 6 months, and then annually. Using those time periods, we built test portfolios and compared that to the average return for the S&P 500 over the same time period. And what we found was that weekly, quarterly, and annual did not perform up to the level of the S&P 500, meaning that you could invest in an index fund and produce a better return than what you would get if you were trading your own stocks on a weekly, quarterly, or annual basis. What we found is that weekly is too frequent. It's not long enough to create any value, which is also why we don't believe in day trading. We do cover what we call popularity-based trading in Portfolios 400, which are some of the basics to be aware of, but in general, we don't encourage it unless it's your full-time gig. And if it is, hopefully you're professionally trained, and this training is just helping you build on some knowledge that you already have. Our results show that to capture the highest return for your assets, you should rebalance your portfolio at least twice a year, and if you can keep up with it, you want to do it every month or two. That sweet spot is really in that 4 to 8 week range, although keep in mind that based on the strategy you pick for asset selection, different optimization time periods are recommended, and we'll go through each metric in more depth in Portfolios 400 and just what our testing shows to leverage for the optimization frequency for each. You may recall in Portfolios 100, we got into the topic of risk aversion. Risk aversion is the concept of balancing your portfolio between a risky portfolio or stock-based portfolio and a risk-free portfolio or something that's more low risk like bonds or fixed income products. The important part of risk aversion is understanding what that balance means for you. So how do you figure out what that balance should be? Well, you can take a risk aversion quiz, and that will calculate your level of risk aversion, and it will tell you how much risk you should take on and what that balance looks like for you based on your risk profile. Hopefully you took the quiz after Portfolios 100, but if not, as a reminder, there's a free quiz sponsored by this program over at riskaversionquiz.com. It's only 8 questions long, and all of the questions are situational based, where you answer buy more, do nothing, or sell. It takes about 5 to 10 minutes to take the quiz and get your results. I've taken the quiz a number of times, and on average, I get a score of 14, which is a slightly risk-averse profile. In the example on the screen, this individual scored a score of 13, which would indicate that they should put 54% of their investment in stocks and 45% in bonds. In the previous example, we used a $10,000 portfolio, so let's revisit that and show you what that portfolio looks like when you apply risk aversion. So taking another look, we now have our risky and risk-free portfolios divided according to our level of risk aversion. And from here, we bring in the optimal portfolio to represent our risky portfolio. And for our risk-free portfolio, I'd highly recommend that you talk to investment professionals if you want to consider options outside of bonds or cash. They'll have other products that they can sell you that also fit into that profile, and by allowing them to sell you those products, you might get some free advice on your risky portfolio. The assets shown here for the risk-free portfolio are just done for example, with 40% in T-bills, 40% in bonds, and 20% in cash. We're not recommending that this is the best allocation, we're just providing it as an example. And then for your risky portfolio, you can see that you reallocate the number of shares you purchase based on the new value of the risky portfolio. And this last graphic here is just a representation of your overall portfolio to give you a different perspective on how you've just allocated your total investment. Once you've established your portfolio, while that's a great feeling, many people are stumped as to what to do next. So I want to take a moment to talk to you about rebalancing your portfolio. Earlier, we were talking about optimization, and we said that every 4 to 8 weeks you should come back and optimize your portfolio. So what do we mean by that? Well, if you look at this table, you have your initial optimal portfolio here on the left. It's possible that your original set of weights is still the optimal portfolio. However, at this point in time, since a few weeks have passed by, the values of your investments have changed. And when we compare the current amount of money in the portfolio with the original optimal weights here in the blue section in the middle, it tells us where we should actually be based on the original optimal portfolio. Before you just go ahead and rebalance to that, you want to go back to your optimizer and check again to see if those weights are still the optimal portfolio. And in this example, when we checked, we found that there was actually a new optimal portfolio. So now, in order to move to that from a rebalance standpoint, the yellow section here shows you the amount of money that would need to be moved around based upon the current share price. And that means that this final recommendation section represents the number of shares that would need to be traded. So the recommendation here was to sell 2 shares of the first stock, 8.5 shares of the second, and so on. And that would get us rebalanced to the new optimal portfolio, which is what you want to do to have the best chance at earning the best return based on what's worked historically. Now, obviously, returns are not guaranteed, nothing is, but these are the methods that fund managers leverage on Wall Street, and you should learn to leverage them for yourself. The next question you might have is, what should you be measuring yourself against? And the market's return is generally represented by a number of indexes like the S&P 500 or Dow Jones Industrial Average. Those are always good benchmarks to use. Tracking your performance to indexes will help you know if you're leaving value on the table by not having the right investments, or perhaps you've seen much more value creation, so now you're thinking more about how to protect your gains. So having a benchmark, which could include your favorite investor's portfolio or whatever you want to compare yourself to, that just gives you a good measuring stick to know whether or not you should be happy with your results. Now keep in mind that over a 10-year time period, no one beats the indexes, at least not when managing large amounts of capital. So keep that in mind when you see certain individuals experience large gains when you're not. It's actually pretty rare, so making sure you're using the right comparisons can make all the difference. You want to be invested for the long haul, and that's where these strategies can help you. Before we move on, I just want to go back to this chart once again. Hopefully now you've got a better understanding of asset and portfolio grades and how portfolio optimization works. In Portfolios 400, we'll go through the performance of the different strategies and how each tested. And that lesson will really help to complete the picture here and bring this method together. The other lessons are still important too. They add context to your portfolio's performance by showing you how to research and what to look out for. The time value of money is something that when you're taking finance courses, this is one of the first concepts that they want to talk to you about. And what I found was that I became so focused on this concept that it was distracting when trying to learn other things. So I've put it as the last topic for today as a way to help keep your attention on those other topics. The time value of money is a concept that can help you understand future value creation or interest payments and how much things will cost you over time. And if you're young, it's a fun way to see how money grows over time, and it's a great principle to apply to your investments. You may have heard investors say that compound interest is king, or something to that effect, and really what they're saying is that over time, the interest accumulation on your investments becomes so large that it can cover all of your needs, and in some folks' cases, they can't spend it faster than they can make it. So it's literally how the rich get richer. Of course, it's not as much fun when you're applying it to calculating debt payments, but this is also where amortization schedules come from and how they're built. So in an effort to provide you with a simple example, let's look at how dramatically each path can have an impact on your life. For this example, let's assume you're 24 years old. While this is not an endorsement of either of these paths, we want you to consider the following scenario. When you were 18, you could have gone 2 different ways. You could have gone to college, maybe have a study abroad experience, and then gone on to grad school, where after 6 years you've earned your second degree, and to keep it simple, you're now $200,000 in debt. And if you're 18 today, this could be very close to the reality that you'll experience. Now, I want you to consider a second path. This time, think about going to a community college for a 2-year degree, then going on and getting an apprenticeship as a plumber or an electrician. Now you have an associate's degree and are a certified skilled trade. After another year or two, you've been able to make some of the purchases that you wanted, so now it's time for you to start putting away your money so you have it for a rainy day and so you can grow it for generations to come. So what do these two paths look like? Well, by looking at this chart, you're probably thinking that the answer is obvious, where one 24-year-old can start putting away money and building wealth, and the other is deep in a hole and just beginning the process of digging themselves out. Which, by the way, was probably a path recommended to them by all of the successful people that they've met so far in their life. So assuming both are seeing 8% interest rates, this chart represents the different outcomes. And as you can see, after 20 years of both contributing $20,000 of payments per year, the one path ends with the individual walking away debt-free, which is a great feat and should be celebrated, but at the same time, the other person is now a millionaire and their money is going to be making them more than $80,000 per year. Now, if you're 44 and looking at this as a millionaire, congratulations. However, if you're 44 and looking at this and you still have a mountain of college debt and you feel like there's no hope, I can assure you that's not the case. You just need to sit down and make a plan of attack. If you don't know where to start, meet with a financial advisor. And keep in mind, this example is over a period of 20 years. It's not a lifetime, so you always have time to get started. The only bad choice you can make is by not investing to begin with. The market is there for you to use, so you might as well get started. Just make sure when you do start that account that you also establish a savings account. Everyone always has those moments where they're in a pinch and you have to have cash on hand, so by doing that, you will put yourself in a position where you aren't forced to sell off your investments, and if you do that, compound interest will do its thing, and you'll be able to capitalize on this opportunity.